Hello everyone, my name is Sagar Dahal and today with my teammates Hamid and Biswas we will be presenting an important and impactful topic, financial inclusion. Before we dive in, think about this, over 1.4 billion still people still in the crisis of financial services like bank accounts, loans and digital payment. Imagine living in the world where we cannot securely save money, pay bills online and apply for a credit. This is the reality for many people in especially in developing countries. Our presentations will cover what financial inclusion is and why it matters, how it is measured and global trends, challenges, consequences and policy implications. Financial inclusion refers to the access, usage and quality of financial services for individuals and businesses. Research highlights financial inclusion as a crucial tool for economic stability. It enables economic participations, financial resilience, and poverty reductions. Financial inclusion is essential for empowering individuals and businesses by providing access to formal financial service, leading to improved economic opportunities and stability. In slide 2, motivations. Why is financial inclusion important? It is a key driver of economic growth and poverty reduction. It empowers individuals and businesses by giving them access to financial services. It promotes financial stability and resilience. Third one, how is financial inclusion measures? It measures by different common indicators, percentage of adults with bank accounts, availability of ATMs and bank branches per capita, access to digital financial services, uses of credit and insurance services, data source, Bank Global Index. Fourth one, the development of financial inclusion around the world. It belongs to high inclusion. It means developed countries have more than 90% of adults have bank accounts in OECD nations. Developing regions, Sub-Saharan Africa, South Asia show progress but remain behind. And digital finance impact, mobile banking and fintech are digital driving financial inclusion in emerging markets. And who is financially included versus excluded? Urban populations, high income individuals, educated peoples are included, and rural populations, low income households, women's informal sector workers are excluded, and the barriers have high accounts cost, lack of documentations, low financial literacy. And challenges in providing financial services, that is limited banking infrastructure, lack of branches in rural areas, high cost operational cost makes serving low income individuals less profitable for banks. Credit history issues, lack of formal credit history prevents access to loans. Regulatory constraints, compliance requirement can limit financial inclusion efforts. Consequences of financial exclusion. Reliance on informal services. Loans charge high interest rates. Economic inequality. Limited opportunity for wealth accumulations. Financial instability. Lower ability to cope with financial shocks. And the hypothesis of financial inclusions are economic growth link. Greater financial inclusion leads to higher economic growth and lower poverty rates. Role of digital finance. Digital financial service improves access in underserved regions. Institutional quality matters. A strong governance positively impact financial inclusion. Financially literacy rate. Education improves financial decision making. And now Hamid will continue.
Yes. Hi, I'm Hamid Khanzadeh, and I start with financial inclusion measurement. Financial inclusion is measured using indices like the logarithm of financial inclusion, financial inclusion index, and digital financial inclusion index. These indices are based on access to bank accounts, ATMs, mobile banking, and digital payments. Some empirical approaches and causal interpretation in the articles consist of dynamic panel generalized method of moments, or GMM. This method addresses endogeneity by using lag variables as instruments, ensuring robust causality analysis. Fixed and random effects models. These models account for unobserved heterogeneity across countries or regions by isolating time invariant characteristics. Data envelopment analysis, or DEA, a non-parametrics technique used to measure the efficiency of financial institutions in promoting inclusion. Instrumental variable regression, or IV, this approach addresses reverse causality by using external instruments such as the distance to financial hubs to predict inclusion. Difference in differences used to compare the impact of financial inclusion policies before and after implementation across treated and control groups. Dependent variables include the logarithm of financial inclusion, household consumption per capita, bank efficiency, non-performing loan ratio, and credit growth during financial crisis, and so on. Control variables are such as economic factors like GDP per capita and inflation, institutional quality or governance indicators, financial openness, human development, digital literacy, and household characteristics like education, income, and location. The articles reveal significant insight into the drivers and consequences of financial inclusion. For instance, improvement in institutional quality leads to increasing financial inclusion, showing that strong governance encourages participation in formal financial systems. Increase in GDP and improvement in Human Development Index increase financial inclusion. Fintech adoption increases household consumption and reduces consumption inequality, particularly for undeserved households. Inclusive banking improves bank efficiency by reducing reliance on volatile funding. Banks in developing economies benefit more from financial inclusion than those in developed countries. Digital transformation reduces non-performing loans by enhancing credit evaluation, but excessive inclusion without proper risk assessment can increase credit risks. Higher financial inclusion mitigates credit costs during crisis, but a rapid unregulated growth in borrower numbers may amplify boom-bust cycles. Thank you, and Biswas will continue.
Okay, moving toward the main conclusion, we conclude that the financial inclusion is a powerful tool for reducing income inequity, promoting economic stability, and enhancing social welfare. Financial inclusion is shown to mitigate the negative effect of financial crisis by increasing access to credit and reducing borrowers' defaults. However, barriers such as high banking costs, lack of documentation, and low financial literacy continue to hinder full inclusion. Digital finance and fintech have significantly improved financial access, especially in developing economies, but challenges like digital literacy gaps remain. While financial inclusion has many benefits, some studies concern that rapid expansion without regulation can lead to credit booms and financial instability. Overall, the research emphasizes the need for balanced policies that expand access while ensuring financial stability. Moving towards conflicting conclusion and reason. Yes, there are some conflicting conclusion among the paper. One area of disagreement is the effectiveness of different policies. Some studies highlights the reducing banking cost and increasing financial institution density are the most effective measures, while others argue that financial literacy and economic development play a more significant role. Additionally, while most papers agree that financial inclusion reduces inequality, a few warn that poorly designed policies may unintentionally exclude certain groups. The role of fintech and digital banking also present mixed findings, with some studies emphasizing its potential to expand access, while others highlight the risks of digital exclusion due to internet access and literacy gap. These differences likely stem from variation in datasets, methodologies, and regional contexts. Studies based on developed countries may yield different results compared to those conducted in emerging economies where banking infrastructure and digital literacy levels may significantly vary. Most convincing findings are those that emphasizes direct benefit transfer scheme over interest rate subsidies as an effective methods for increasing financial inclusion. These policies are shown to reduce inequality while minimizing market distortion. Additionally, the evidence support financial inclusion as a means to enhance economic resilience is highly persuasive, as countries with higher financial inclusion tend to experience less severe economic contraction during crisis. Some of the policy implications are derived from the paper suggest that financial inclusion efforts should prioritize marginalized groups such as women, rural population, and low income individuals. Governments should expand mobile banking and digital finance solutions while addressing challenges related to digital literacy and internet access. To prevent financial instability, regulators should monitor credit expansion and ensure that financial inclusion policies do not lead to excessive borrowing and debt accumulation. Direct benefit transfers should be encouraged as an effective tool for improving financial access, as they provide targeted financial support without distorting market. Additionally, financial education initiatives should be integrated into policy framework to ensure that individuals can make informed financial decisions and fully utilize available financial services. Lastly, criticism of the study and conclusion. One major criticism of the study is the reliance on randomized controlled trials in some cases, which, while useful for measuring some short-term impact, may lack external validity when applied to different countries or economic contexts. Another issue is that some studies use aggressive cross-country data, which may oversimplify key factors such as cultural, institutional, and economic differences that influence financial inclusion. Additionally, a significant limitation in many studies is their focus on formal financial system while neglecting informal financial practices that remain prevalent in many developing countries. Without considering these informal mechanisms, the studies may underestimate the actual level of financial participation and the impact of financial inclusion policies. Future research should address this gap by incorporating many localized data and exploring how formal and informal financial systems interact in different contexts. Lastly, these are the papers which we reviewed. In the next slide. Yeah, thank you.